Welcome to today's Explainer. Right now, we're tackling a massive, massive question that could literally save you thousands of dollars. We're going to look at ETF versus mutual fund tax efficiency. Look, if you want to keep more of your hard-earned money and avoid these hidden, frustrating portfolio leaks that just completely destroy your compound growth, you are in the exact right place. We're going to break down a concept that usually takes a finance degree to understand so you can structure your investments like an absolute pro. Let's get right into it.
Picture this. You log into your brokerage account in December. You haven't touched your portfolio all year long, right? You haven't clicked sell a single time. Yet, boom, you get hit with a surprise tax bill out of nowhere. This incredibly frustrating concept is what we call the phantom tax. It's basically the central mystery of why mutual fund investors frequently get hit with these year-end capital gains taxes, even when they're just classic buy-and-hold investors. It feels completely unfair, doesn't it? You didn't cash anything out, so why on earth is the IRS knocking on your door?
Well, okay, let's dive into this because the financial damage of this phantom tax is very, very real. Based on a 5-year study by T. Rowe Price, if you had a standard $100,000 investment, this phantom tax could cost you a staggering $6,400. Let that sink in. That is money siphoned directly out of your compounding machine, lost forever to taxes, simply because of the specific type of wrapper your investments were sitting inside. Section 1. A Tale of Two Investors. To really understand how this happens, let's look at two hypothetical investors, represented by our trusty stickman animations here on the screen. We've got mutual fund Mike, and we've got ETF Emma. Now, both start with exactly $100,000. Both choose a brilliant strategy that successfully generates a fantastic 13% average annual return over a 5-year period. So at the end of 5 years, both of their accounts have grown to over $183,000. They both won, right? Well, let's look a little closer at what actually happened behind the scenes. Here's where the math gets genuinely painful for Mike. Over those 5 years, Mike's mutual fund was forced to pay out $41,500 in capital gain distributions. And because Mike held this in a normal taxable account, he owed taxes on all of that, resulting in that $6,400 tax bill along the way. But what about ETF Emma? Her fund distributed absolutely zero in capital gains. She paid $0 in taxes during that exact same 5-year period. So while Mike was writing checks to the IRS, Emma was just letting her money compound completely unhindered. Section 2. The Secret of In-Kind Redemptions. So you're probably wondering, how did Emma's ETF pull off this magic trick? Well, it relies on these unsung heroes called authorized participants, or APs for short. Think of APs as specialized institutional middlemen. Normally, when you want to buy or sell an ETF, you're just trading with another investor on the stock exchange. But when there's huge demand or a massive sell-off, these APs step in to keep the gears turning and make sure the ETF's price stays perfectly balanced with the actual value of its underlying stocks.
Let's look at our stickmen in action to see how this works. When an ETF needs to get rid of stocks, let's say to meet a really big redemption, the ETF manager doesn't actually sell the stocks for cash. Instead, they hand a literal briefcase of those stock certificates over to the authorized participant. In exchange, the AP hands back a briefcase of ETF shares. Step 1. Gather the basket. Step 2. Swap the basket. Step 3, because no actual cash is exchanged between the fund and the AP, it's considered an in-kind exchange. And under current tax law, this completely bypasses the IRS. No cash sale means no taxable event is triggered for the fund. It's brilliant.
What's really interesting about this structural contrast is this. When mutual fund Mike's neighbors decide they want to cash out of their mutual fund, the fund manager actually has to come up with cash to pay them. If they don't have enough cash lying around, they are forced to sell off pieces of the portfolio. It's kind of like being forced to sell off rooms of your house. If those stocks went up in value, selling them triggers a capital gain. And by law, that capital gain gets passed on to everyone still inside the house, including poor Mike. ETFs, on the other hand, just swap briefcases with the AP, flushing out the highly appreciated stocks without ever triggering that sale. Section 3. The Active Management Penalty. Now, does this theory actually matter in the real world? Oh, for sure. Just look at this staggering difference in the data. In 2025, over half, 52%, of all mutual funds passed a capital gains tax burden down to their investors. Now compare that to the ETF world, where a mere 7% of funds distributed a capital gain. That is a massive 45% structural tax premium that you're paying just for choosing the older mutual fund wrapper instead of the modern ETF wrapper. And this leads us to an absolutely crucial point: the double penalty. The data shows that 27% of active mutual funds in 2025 actually lost to their benchmark, meaning they underperformed the market, but they still handed their investors a surprise tax bill at the end of the year. So you lose on performance and you lose on taxes. It's brutal. In stark contrast to that, only 2% of active ETFs suffered from this devastating double penalty. Now, you might be thinking, hey, I just buy the passive S&P 500 index, I'm fine. Actually, scratch that. You aren't safe just because you're a passive investor. Look at this table. This brilliantly illustrates that 41% of passive index mutual funds still distributed capital gains in 2025, compared to just 4% of passive ETFs. The wrapper itself, the actual mutual fund structure, is the leak in the boat, regardless of whether the fund is actively picking stocks or just passively tracking an index.
Section 4. Smart Portfolio Construction.
So how do we take all this and actually construct a portfolio to plug these leaks moving forward? First off, I want to be very, very clear. Mutual funds are not inherently bad. They are incredible wealth-building tools, and they absolutely still belong in your portfolio, but they belong strictly inside tax-advantaged accounts. If your mutual fund is inside a 401k, a traditional IRA, a Roth IRA, or a 529 college plan, the IRS literally cannot touch those year-end distributions. The tax shield of the account completely neutralizes the phantom tax. This is exactly why target date funds, which are mostly made up of mutual funds, are absolutely perfect for your retirement accounts. There's also a quick nuance we need to add regarding bonds. Because fixed income behaves a lot differently than equities, bonds mature and pay interest rather than growing massively in principal value, the structural tax penalty of mutual funds is actually much lower here. In fact, 37% of bond mutual funds distributed gains versus 23% of bond ETFs. So the gap is much smaller, which means if you have to hold a mutual fund in a taxable account, a bond fund is far, far less dangerous than a stock fund.
Let's see how this all builds into a real-world strategy, like the incredibly popular 3-fund portfolio championed by Rob Berger and the Bogleheads. To perfectly optimize this, you're going to want to place your total U.S. equity and total international equity ETFs right there in your taxable brokerage account. Let ETF Emma do her magic there. Then, take your total bond market funds, which can safely be mutual funds, and hide them securely inside your tax-advantaged IRA or 401k. By doing this, you get maximum growth, maximum diversification, and literally zero tax drag.
Which brings us to our final critical question for you today. Have you checked your taxable brokerage account recently? I challenge you to log in as soon as this explainer is over and take a look. Are you unknowingly paying mutual fund Mike's double penalty every single December? By simply swapping to an ETF equivalent, you can plug that tax leak and keep your wealth compounding. It really makes you wonder, with structural flaws this glaring, why on earth is the old mutual fund system still the default for so many investors? Thanks so much for joining me today, and happy optimizing.